Good morning, everyone, and thank you so much for joining us to our first ever webinar. My name is Sherry Babowski. I'm the Retirement Benefits Manager at the Fund Office. I've been with the Fund Office for a little over 30 years, and I've been doing in-person seminars for about 20 of those years. However, today is our very first webinar, so cross your fingers along with me that everything goes well, and I hope you learn a lot. If you are having trouble hearing the broadcast, you can listen in on your telephone. So if you have some static over your computer or something, you can call in and listen on the phone, and you can watch the broadcast on your screen. At the end of the webinar on your screen, a survey will appear. It would take you no longer than maybe a minute or two to fill it out, but I would greatly appreciate if you could give us some feedback. What did we talk about that you wanted to hear more about or not enough about? How did you feel the pace of the webinar went? Just a few questions like that. I think there's 6 short questions, please. During the week, you were emailed a link to the handouts for the webinar, and we also emailed you your personalized benefit printouts. Now, I did notice this morning when I logged in, there were a couple of people who registered on Thursday and Friday. So you probably, in fact, not even probably, I know you didn't get emails with your personal printouts. So for those 3 people, we will email you your personalized estimates and printouts in the upcoming week. If you are watching this broadcast on a laptop computer, you can, on the right-hand side of your screen, you should see a little orange and white arrow. And if you click on that arrow, a window would expand and it would let you access the handouts. And it would also let you ask a question by typing in, and we'll show you that in a minute. If you are looking at this broadcast on a cell phone, if you look at the picture in the bottom right-hand corner of the slide, next to the question button on a cell phone, to the right of that, there's a little button that shows handouts. So you would be able to access the handouts if you're looking at it on a cell phone over there. I will pause for questions at the end of each section. To submit a question, you're going to click on the question button, and you're going to type your question, and I will see that appear on my screen. Please ask general questions only. Personal questions that apply to you, your benefit calculations, your credits, things like that. I would ask that you contact the Retirement Benefits Department during the week, and any of the retirement benefits representatives would certainly be happy to speak with you about your personal questions about your own record. We only have 2 hours for this webinar. Now, 2 hours is a really long time for a webinar, and we will take 2 breaks during the course of the webinar. But when we do these seminars in person, they're actually like about 4 hours, 4.5 hours of talking. So I'm going to answer the questions that I can get to. If I can't get to your question, please don't be offended. Please just give the Retirement Benefits Department a call. All of the representatives there would be very happy to help you. In the handout packet, the pension handout packet, on page P2, there's a telephone number sheet there. It gives you the phone number for the fund office, which most of you are probably already very familiar with. But it gives you also phone numbers for things like Blue Cross and Blue Shield, for the Social Security Administration, for Medicare, things like that. As I just mentioned, call the fund office for personal questions. The fund office right now, due to the governor's stay-at-home order and the whole situation in the world right now, the fund office is actually closed to outside visitors. However, the fund office staff is working remotely. We are there to answer your questions over the phone. If you have a short question, just give us a call. If you want help filling out a pension application or a supplemental retirement application, we are still taking appointments. We're just doing those appointments over the telephone. So we're happy to give you all the time you need. Think about scheduling a phone appointment. Okay. So that's sort of our housekeeping stuff for today's presentation. We will talk about a variety of things today. We'll start off talking about what you need to do to start your pension, how you need to stop working, and what type of work you can possibly do after your pension begins. We're going to spend the bulk of our time today talking about how your pension benefits are calculated and all of your different pension payment options. We'll touch on the supplemental retirement plan, and then we'll also spend a good deal of time at the end of the presentation talking about retiree health care benefits, premiums, and coverage. So let's get started. Our first topic is retirement and suspension of benefits. So I would imagine most of you, you're ready. You're really ready to go. A lot of you, when you filled out your registration, we asked whether you were just looking for information or if you're actually ready to retire. And about half of you responded that you are actually ready to retire. So in order to start your pension, IRS regulations and the plan provisions require two things to happen. There has to be a legitimate severance of employment, and you cannot be working in prohibited employment. A legitimate severance of employment means that you are stopping work for any employer who is signatory to the pension fund, and that you do not have any intention of returning to employment with a signatory employer. Okay. The second part of this is that you cannot be working in any type of prohibited employment. And we will talk about what prohibited employment is in just a moment. Lately, the question about severance of employment seems to be coming up a lot. Many people seem to believe incorrectly that if they're not working in a prohibited capacity for a signatory employer, that it's okay to start their pension. So, for example, you work for XYZ Construction Company, and you are working for XYZ Construction Company as an estimator. Being an estimator is not prohibited employment. You are allowed to draw your pension and be an estimator. However, because XYZ Construction is a signatory employer, you can't just simply start your pension because you're working in a non-prohibited capacity. You must stop working for any employer who is signatory to the pension fund in order to start your pension. Okay. Again, this is an IRS regulation and a pension fund regulation. Okay. Additionally, a prearranged termination and rehire doesn't qualify as a severance of employment. So, for example, you've got some vacation time built up, or maybe you know your boss and you say to your boss, Tom, hey, Tom, I want to start my pension, so I'm going to quit and I'm going to go down to Florida for a month, and then I'm going to come back. And hey, Tom, you're going to rehire me when I come back from Florida, aren't you? That's a prearranged termination and rehire. It does not qualify as a legitimate severance of employment, and you would not be allowed to start your pension after such a situation. There is an exception to the severance of employment requirement. Okay. If you have reached normal retirement age is age 65. And if you are not working in prohibited employment, then you do not need to sever employment to start your pension benefits. So in my example just now, you're working for XYZ Construction and you're an estimator, but you're age 66. Then it is permissible to start your pension without a severance of employment. Okay. So severance of employment is more relevant prior to age 65. And let me qualify that. It's more relevant prior to age 65 as long as you're working in a capacity that is not considered prohibited employment. Okay. So what is considered prohibited employment and what isn't considered prohibited employment? That's always a big question. So in the pension handouts, if you look at page P3, from page P3, page P4, and P5, there are 3 pages in the handout talking about what is and what isn't prohibited employment. Okay. You cannot be working in a capacity or other business activity performed in the trade or craft of carpentry or in a capacity covered by a collective bargaining agreement with the fund. So you can't continue to work with the tools. Okay. There are some things that are specifically allowed, and there are some things that are specifically not allowed. And that listing is on page 4 of your handout, your pension handout. Okay. So things that are still considered prohibited employment, you can't be a supervisor or a superintendent. You can't work as a project manager. Okay. You cannot be a building inspector for a contractor. Those types of things. Okay. Things that are specifically permitted, well, one of them I just gave, you're allowed to be an estimator. You're allowed to do picket duty working for the union. You're allowed to be a safety director for a company and several other things. So prior to age 65, you cannot work in any occupation or capacity that would be considered prohibited employment at all, not even for 1 single hour a month. Okay. Pre-65, any month in which you work in prohibited employment, again, even if it's as short a time as 15 minutes or an hour, you would not be entitled to your pension benefit for that particular month. Once you reach age 65, you are allowed to work in prohibited employment for less than 40 hours a month. Okay, this is commonly called the 39-hour rule. So once you're 65, you can work less than 40 hours a month in prohibited employment and have employer contributions come in on your behalf for less than 40 hours a month, as long as you are already age 65. In order to take advantage of that 39-hour rule, you do need to complete a form for the pension fund office, and that form is on page P6 of your pension handout. You need to fill out this form just one time to say, yes, you are going to be working under the 39-hour rule, and that you understand you are limited to less than 40 hours a month, and that you understand you would have to repay any pension benefits if indeed you hit the 40-hour mark or go over the 40-hour mark in any given month. Again, that's starting at age 65, and that runs up to age 70 and a half. Okay. Once you are 70 and a half, you are allowed to draw your pension and work full-time in any capacity that you want to. There are no work restrictions once you're 70 and a half. Now, when we're in the seminar room, when we're doing these in person, usually a great big up across the room at this point in time. We have about 15,000 retirees, and we do have about 24 age 70 and a half or older who are working full-time and still drawing their pension. Okay. And that is in accordance with the plan restrictions and with federal regulations. There are always a lot of questions about what is considered prohibited employment and what is not considered prohibited employment. So what we suggest you do is, before you go back to work, if you're already retired, or if you're not yet retired and you're not sure about whether or not your particular occupation would be considered prohibited employment, you send a job description, a written job description on the employer's letterhead to the Retirement Benefits Department. We will review the job description and we will respond back to you in writing and let you know whether or not that job will be considered prohibited employment. This written exchange, it protects you and it protects the plan. Because what could happen is you go back to work in a job that you think is not prohibited, but we discover that you're working and we determine that that job is prohibited employment. It falls into the prohibited employment category. And we tell you that we're going to suspend your pension and that you owe us back the money you received for any months in which you worked in that capacity. And you call us up and you say, well, I called the retirement benefits department and I talked to Joe in the retirement benefits department, and Joe in the retirement benefits department, he told me that this job was okay. Well, guess what, folks? There's no Joe who works in the retirement benefits department. Okay. It's safer for you and it's safer for us. We have everything in writing, in your file, and on the record if you don't know whether or not the job that you're thinking about is prohibited employment. The biggest category we get inquiries about is about maintenance work. Some types of maintenance work are considered prohibited employment, and some types of maintenance work are not considered prohibited employment. So, for example, if your type of maintenance work is sweeping the floors and emptying the garbage cans and cleaning the windows, that type of maintenance work is not prohibited employment. However, if you're thinking of doing maintenance work that would involve fixing how a door is hanging on its hinges, or rekeying locks, or repairing walls or windows, that type of maintenance work is considered prohibited employment, and it is not allowed under the terms of the plan. Okay. There are usually quite a few questions at our in-person seminars about prohibited employment. So I will pause now and give you a chance to ask some questions. You can click on your question icon and you can type over a question. Okay, I don't see anything coming through. From experience at the in-person seminars, sometimes people will ask a question about, my son wants a deck built on his house. Can I help my son build a deck on the back of his house? And the answer to that is, yes, you can. You can certainly still help friends and family with their repair projects or home improvement projects, as long as you're not getting paid a salary or a benefit. So if you help your son build a deck, make sure you have a nice barbecue outside, and he picks up a couple of nice steaks right now, which are really, really expensive with the price of meat, and that you have a barbecue outside and you do some nice social distancing out there too. So have him pay you, in that way, or just a nice thanks, Mom and Dad, for helping me out. I'm still watching the question box and nothing is coming through. So I'm going to move on. Usually we have a few more questions. If you do think of a question about prohibited employment, please go ahead and send it over. Oh, here, we had a couple come through. Can I supervise someone who is doing door repairs? Well, that would be working in a supervisory capacity. So no, you would not be able to do that. Someone is also asking about being a building engineer. A building engineer, I would suggest you would send in a job description, because off the top of my head, I'm not sure exactly what job duties are involved in being a building engineer. Someone is asking about safety director. Being a safety director is allowed. It is not considered prohibited employment, and that is specifically listed on the handouts on page P4 of the handouts. The safety director is okay. 3 separate questions came in about flipping houses. Flipping houses is technically prohibited employment. So flipping houses would not be allowed. It would be considered prohibited employment. Working as a consultant. You can be a consultant regarding the viability of a project. So if you're basically looking at blueprints, things like that, and working with the employer, determining whether or not a project is viable, that is allowable. Okay, I am going to move on now because we do have a lot of material to cover within our 2 hours. If you do have a question, if you had difficulty asking a question, typing a question, please give the Retirement Benefits Department a call. If you're having difficulty with the presentation asking a question, I remind you that you click on the orange arrow, the orange and white arrow box on a laptop, or the little question icon on your telephone to type in a question as we go on. So your pension benefits. How are your pension benefits determined? And we're going to talk about all of the different payment options that are available for you to choose from. So most of you, as I looked at your personalized printouts when I emailed them over the last couple of days, most of you have been with the Carpenters Fund for many years. A lot of you have 30, 40 years in. Some of you had a few less, but I believe most of you are familiar with how you earn pension credit. Your employer contributes to the pension fund in accordance with the employer's collective bargaining agreement. Okay. No monetary contributions are required from you. And in fact, no monetary contributions from you are permitted. Yes, you've given your blood, sweat, and tears to this trade for however many years you've been involved in the Carpenters Union and earning pension credit with us, but the employer has made contributions to the fund on your behalf. Every year in the mail, you receive an annual statement of pension credit that shows how many pension credits that you've earned. Pension credit is earned based on hours worked on a calendar year basis from January 1st through December 31st. Less than 250 hours in a calendar year does not give you any pension credit. At least 250 hours gives you a quarter, 500 gives you a half, 750 3/4, and 1,000 gives you a full year of pension credit. Starting in 1989, for the construction pension plan, it became possible to earn more than 1 year of credit within any given calendar year. So if you work at least 1,500 hours, you earn 1 1/4 pension credit. And if you work at least 1,750 hours, you earn 1.5 years of pension credit. Those extra quarters and halves for the 1,500 or 1,750 hours, those are counted toward pension computation, but they do not count toward vesting services. Okay. So if you would, if you printed them, or maybe if you haven't printed them, if you could look, or how hopefully you have looked, in your personalized handouts, the first sheet is marked with a capital A in the top right-hand corner, and it shows your personal credit history. So some of you who may have attended seminars in person in the past, you notice that this looks different. We got a new computer system this year, so your printouts look a little bit different for how the credit's displayed, but all of the information there is the same. Okay, so these were emailed to you Thursday and Friday. Okay, so at the bottom left of your personalized credit printout, you will see some totals, and you will see a vesting credit total, and you will see a pension credit total. Vesting credit is used to determine whether or not you're eligible for a pension. It's used to determine whether or not you're eligible for retiree health benefits, and it's used to determine how much you pay for retiree health care benefits. Okay, so please take note of how many years of vesting credit you have, because that will come into play a little later in the presentation when we talk about retiree health care benefits. Okay. Your pension credit, and again, the pension credit includes those extra halves or quarters. Your pension credit includes the extra halves and quarters, and that's what's used in calculating the amount of your monthly pension benefits. Okay. Also in your personalized handouts, we've sent you some dollar estimates. Okay. When you registered, if you indicated that you are ready to retire and that you have a date in mind, the estimates that we emailed out to you utilized the date that you listed on your registration. Okay. If you did not give us a date, we used July 1st for your estimate date. Unless you were not yet age 55 for the construction fund or 60 for the Millman fund, those are the early retirement ages, then we use the date that you would turn age 55. Okay, so for most of you, the estimates were based on July 1st or the date that you gave to us. The estimate that you received is based on the credit that you have earned to date. We do not project future credit that you might earn. Okay, so it's only based on the hours that you've worked in to date and have been reported to date. So these estimates should include any hours that you worked through the end of the month of April of this year, because your April hours were paid in and due by your employers by May 15th, and the contributions department has most of those hours posted already. Okay. So if you're looking at that personalized estimate, or if you have looked at it, you can see what your numbers are. Now let's talk about how we arrived at those numbers. All of your earned pension credits are multiplied by what's called a benefit accrual rate. Okay. The current construction plan benefit accrual rate is $100 per year of pension credit. The current Millman pension plan accrual rate is $66 per pension credit. Okay, provided for both of these rates, the $100 and the $66 rate, the qualifier on that statement is that provided that you have never incurred a 3-year break for calculation purposes. A 3-year break for calculation purposes means that at some point you went 3 consecutive calendar years without earning at least a quarter year of pension credit in any of those years. So if you have a 3-year break for calculation, any credits earned prior to the 3-year or more absence will be paid at the accrual rate that was in place before the 3-year break. And then any new credit, if you returned after the 3-year break, would be paid at the more recent benefit accrual rates. I think I saw about 4 of you registered today have a calculation break where some of your credit is paid at an older accrual rate. But you can see your individual rates on the estimates that were emailed out to you. Okay. In the construction plan, there is no reduction for age once you are age 60. In the Millman plan, there is no reduction for age once you turn age 65. If you commence your pension prior to age 60 in the construction plan or prior to age 65 in the Millman plan, you will have a reduction for your age. It's called the early reduction factor. On the construction plan, that reduction is 5% a year for each year that you're younger than 60. And in the Millman plan, that reduction is approximately 6.6% for each year that you are younger than 65. On the construction plan, the earliest you can start your pension is age 55. On the Millman plan, the earliest you can start your pension is age 60. Now that reduction factor, let's just talk about the construction plan reduction factor for a moment. That 5% reduction is actually prorated by month. So if you start your pension at age 59 and 11 months, you're not going to lose a whole 5%. You're only 1 month younger than 60, so you'd lose a 12th of 5%. So the 5% is broken out by months. For each month older you get, the less your reduction factor actually begins. So let's look at an example. And again, you have your personalized printouts that were sent out to you. So the example we're going to use, and we're not just going to look at it on this slide, but this example is going to carry through on our future slides as we talk about the different benefit options. So our example participant is a participant in the construction plan, 60 years old. He's worked for 41 calendar years. But because of those extra halves and quarters that he's earned for working additional hours within a given calendar year, he's actually earned 49.5 pension credits over those 41 calendar years. So what we do is we take the total years of pension credit, the participant has earned, and we multiply by the benefit accrual rate, the $100 benefit accrual rate. So in this case, the 49.5 years of pension credit multiplied by the $100 benefit accrual rate gives us a monthly benefit amount of $4,950. Okay. So on your personal printout, you can see what your calculation is. Because this participant is 60 years old, there is no reduction for that participant's age. Now, I have a couple of slides coming up that will show you an example of a calculation for someone who is not yet age 60 for the construction plan or age 65 for the Millman plan. Okay. Before I move on to another slide and talk about the math, I'd like to talk about what this term 60 certain guarantee means. So on your personal printouts, you see that the A option is called a 60 certain guarantee. This monthly benefit amount listed here in our example of $4,950, that is the monthly pension amount that the carpenter, that the participant will draw for as long as the carpenter lives. So if you, the carpenter, elect the 60 certain guarantee form of payment, and if you live for another 50 or 60 years after you retire, you will get a monthly pension of $4,950 a month every month for the rest of your life. There is no maximum number of payments. It is a lifetime benefit. And although there are no maximum number of payments, we do guarantee a minimum of 60 monthly payments. 60 months is equivalent to 5 years. So if you choose the 60 certain guarantee form of payment, and if you receive less than 60 monthly payments before you pass away, the remainder of the monthly payments would be paid to your designated beneficiary. So for example, if you receive 40 monthly pension payments and then you pass away, the fund has not fulfilled its guarantee of at least a minimum of 60 payments because you've only received 40. So there would be 20 more payments due to your designated beneficiary. So the 40 payments that you received while you were with us, plus the 20 payments that we will pay to your beneficiary, will add up to our 60 certain minimum guarantee. Second example, you receive 59 monthly payments and then you pass away. There would be one more monthly payment due to your designated beneficiary. Okay. Sometimes this causes confusion. People think that if you pick the 60 certain guarantee, that you only get 60 payments and then your pension stops. That is not correct. It is a lifetime benefit for the carpenter for as long as you live. Okay. Sorry, my slides are frozen here. Give me a second. Again, it's our very first webinar, so please be a little bit patient here. There we go. I apologize for that short delay there. So second example, we're still looking at a 60 certain guarantee, okay? But this particular carpenter is only 58 years old. Okay, he's only 58 years old, actually 58 and 2 months old. He's worked for 32 years and earned 42 pension credits. This participant also has not incurred a 3-year calculation break. So he's had a solid record all the way up and through. So we take his 42 years of credit, we multiply by the $100 benefit accrual rate, and we apply the reduction factor that exists because he's only 58 and 2 months old. Now, if you remember, the construction reduction is 5% a year for each year that a participant's younger than 60. So if this participant were going out at an even 58 years, no months, just plain old 58 years and 0 months, he would lose 10% because it's 5% a year for each year that he's younger than 60. If you go out at 58, you're 2 years younger than 60, so it's a 10% reduction. So 90% would be a 10% reduction. But because this participant is 58 and 2 months, he gets a little bit more than the 10%. So that's where this 833 comes in at the end of the early reduction factor, because we prorate that 5% on a monthly basis. So this example shows the monthly amount of $3,185 that would apply for this participant because of the reduction he's incurring for starting his pension a little bit early. Okay. Age reductions have changed over time. When I first started with the fund office, you had to be 65 years old not to have any type of an age reduction applied to your pension. In 1991, the Board of Trustees moved that age down to age 62. In 2003, the age moved down to 61, where you could retire at 61 without an age reduction. And then in 2004, the age reduction moved down to age 60, where it currently is. So in addition to the age reduction, we're going to look at an example of someone who has a calculation break-in service included on the pension calculation. Okay, so this particular participant is also 58 years old. He worked from 1988 to 1996, and he earned 11 3/4 years of credit. But then he left and did not earn any pension credit from 1997 through 1999. So he went 3 consecutive calendar years without any pension credit whatsoever. But then he returned to the trade and started working for a contributing employer again. And he worked from 2000 to 2019, and he earned 21 3/4 years of pension credit then. So the calculation of the 60 certain guarantee amount for this participant is done in 2 separate steps. First, we take the 11 3/4 years of pension credit earned from 1988 to 1996, and we multiply by a $50 benefit accrual rate, which was in place in 1996. Because the participant is 58 years old, he's also having a reduction for his age. So he's taking a 10% reduction for his age at 58 years. So 11 3/4 times 50 times 0.90 is $528.75. But then we add to that the 21 3/4 years that he earned after he came back to us. So the 21 3/4 is paid at the $100 benefit accrual rate. Again, there's the reduction for the member's age, and that comes out to $1,957. So we just add these 2 numbers together in order to come up with a monthly benefit amount of $2,486. Okay. Plan-wide, approximately 4% of participants have some type of a calculation break. Many times people say, well, how come there's a calculation break? How come nothing can change with this calculation break? There has to be a cutoff at some point in time. It can't be that someone who worked, say, from 1988 to 1996 and then left the trade in 1996 comes back to start their pension now and is entitled to the $100 accrual rate on all of their credit. It's just not fair. Those of you who have consistent credit, worked all the way through, you haven't left the trade or you haven't left for any significant amount of time, you are the ones who are benefiting more from the increased accrual rate as the accrual rate goes up. So there has to be a cutoff at some point in time. The plan financially could not sustain giving the accrual rate, the current accrual rate, to everyone who's never had a calculation break in service. So there has to be a cutoff at some point in time. And when the plan was first conceived, that cutoff was set at 3 consecutive calendar years. If you disagree with this determination, you do have the right to appeal a calculation break. But I will tell you that although you have the right to appeal, the Board of Trustees has never approved an appeal in order to overrule a 3-year calculation break in service. Okay, so still please looking at your personal printouts. The majority of you registered today are married participants. So the few of you who were registered today who are not currently married, this little bit of the presentation doesn't really apply to you unless you're thinking of possibly marrying before your pension starts. So on your personalized estimates, if you go down a little bit past the 60 certain guarantee, you will see 3 additional options: a B option of 50% joint and survivor, a C option of 75%, and a D option, a 100% joint and survivor. All of these options offer you, the carpenter, a way to take a lesser pension amount for your lifetime to provide your surviving spouse with a benefit for the surviving spouse's lifetime. All of these options have what we call a pop-up feature, and I will explain what that means as we go through the next couple of slides. So going back to my original example of the participant who is 60 years old and had earned 49 and a half years of pension credit, who had a 60 certain guarantee benefit amount of $4,950, this $4,950 rate here. That participant is a married participant in this example, and his spouse is the same age as he is. So they're both 60 years old at the time the pension starts. So instead of taking the 60 certain guarantee benefit of $4,950, this participant decides that he wants to make sure that a surviving spouse would have a monthly pension benefit for the surviving spouse's lifetime in case the carpenter passes away first. So what happens is he makes a choice between the 3 available joint and survivor options. Okay. On a 50% joint and survivor option, we take the monthly 60 certain guarantee amount and we multiply it by what's called a joint and survivor factor. Okay. Because this participant and spouse are the same age, on a 50% joint and survivor option, the factor that we use is 90%. Okay. Now, it's not a random factor. We have a whole book of tables from our actuaries, and you can see on your personalized printout what your joint and survivor factor would be. So on a 50% joint and survivor option, we add or subtract 0.4% for each year the spouse is either older or younger than you. Now, you don't have to try and do the math. You can look at your factors on your personalized printouts. Okay. So we arrive at a monthly amount of $4,455. Okay. So this participant, if he chooses, instead of taking a monthly benefit of $4,950 under the 60 certain guarantee, the participant chooses for his lifetime to take a monthly benefit amount of $4,455. The participant would receive that monthly benefit amount for his lifetime as long as he lives. But when the participant passes away, the participant's pension of $4,455 stops, but the surviving spouse starts to get a monthly pension benefit of $2,227.50 a month. It's called a 50% joint and survivor because the spouse's amount is 50% of what the participant was receiving during the participant's lifetime. Okay. Please note also that this is a surviving spouse's benefit. Okay. The surviving spouse's benefit does not start at pension commencement. Okay. The surviving spouse and participant do not draw benefits at the same time. I mean, that wouldn't even make sense. If you add these two numbers together, you come out with more than the $4,950 benefit. Okay. But sometimes it causes a little bit of confusion. So during the seminars, I like to make sure that I point that out. So the participant's amount is for the carpenter's lifetime. And then when the carpenter passes away, the participant's amount goes away and the surviving spouse's benefit starts. Now, that surviving spouse's benefit starts the month after the carpenter passes away. So the surviving spouse does not have to reach any certain age. Okay. It will start immediately. It doesn't matter the surviving spouse's age. The surviving spouse would get the surviving spouse's amount for the rest of the spouse's lifetime. Okay. This holds true even if the surviving spouse subsequently remarries. Okay. On a 75% joint and survivor option, the math works the same way. We start with the base 60 certain amount and we multiply by a 75% joint and survivor factor. So because the participant and spouse are the same age in my example, and they're both age 60, the joint and survivor factor is 85.5%. So on a 75% for each month that the spouse, for each year that differs between the participant and the spouse, we add or subtract 0.6% to this base 85.5. Again, you don't have to try and do the math. You just look at your personalized printouts for that. So on a 75% joint and survivor, instead of the participant getting a monthly 60 certain amount of $4,950, the participant would draw $4,232 for his lifetime. When the participant passes away, the $4,232 stops, but the surviving spouse starts to get $3,174 a month, and that is 75% of the amount that the participant was receiving. Okay. The same thing for the 100%. We start again with the 60 certain amount of $4,950. We multiply by the 100% factor, which is 81% if you and your spouse are the same age. If you are not the same age, we add or subtract 0.7% for each each year that the surviving spouse's age differs from the carpenter's age. So on the 100% joint and survivor option, the participant draws $4,009.50 a month for the participant's lifetime. If the participant passes away first, the participant's $4,009 stops, but the surviving spouse starts to draw a monthly pension of $4,009 on a monthly basis for the surviving spouse's lifetime. Now, I mentioned on the prior slide that there's something called a pop-up feature built into all of these options. Okay? That means that if you choose any of these payment options, and if your spouse passes away first, your monthly pension benefit, the carpenter's monthly pension, pops back up to the full 60 certain amount. In our example, that's the $4,950. But on your personalized estimates, it would pop back up to whatever your personal 60 certain guarantee amount is. Now that pop-up, that increase, starts the month after the spouse passes away. Okay. So you don't get any back money. So if you've been on pension for 3 years and then your spouse passes away, that increase back to the 60 certain amount starts the month after your spouse passes away, but you don't get any back money for any prior months or years of pension payment that you've already received. Okay. Also built into all of these options on the construction plan, this does not apply to the Millman plan, but built into all of these options on the construction plan is also a 60 certain guarantee. So for example, if you choose the 75% joint and survivor option, and you, the carpenter, receive 10 months of benefits at $4,232, and then you pass away after only receiving 10 months of benefits. Your surviving spouse starts pension the month after you pass away, and say your surviving spouse also only receives 10 more payments, and then the surviving spouse passes away. You, the carpenter, have gotten 10 payments. Your spouse has gotten 10 payments. But then you've both passed away. So we've only paid out 20 payments. We guarantee a minimum of 60 monthly payments. The carpenter and spouse together in this example have only received 20 monthly payments. So there are still 40 more payments due at the surviving spouse's monthly amount, and those 40 more payments would be due to your contingent beneficiaries, your secondary beneficiaries. I will pause for a moment for questions. Giving you all a second to type. While people are typing, if they have any questions, I want to mention that part of the handouts are beneficiary forms. You might want to consider updating your beneficiaries with the beneficiary forms that were sent out in the handouts. And we'll talk about why in a moment, because there are also pre-retirement benefits available in case you pass away before your pension starts. And the question that's actually coming in is about the beneficiary forms. So if you take a moment, if you've printed your handouts, and if you haven't printed your handouts, that's okay. In the beneficiary form handouts, there are 6 pages, 3 different forms. The first 2 pages of the beneficiary form handout is for your pension fund beneficiary. So you'd use the first page of that to list your primary beneficiary, who is usually your spouse if you're married. And then you'd use the second page of that form to list a contingent, a secondary beneficiary, on the second page of that form. I usually talk about this during the live seminars too, the in-person seminars, because of course we're still live today. During the in-person seminars, on those beneficiary forms, if you want your children to be your secondary beneficiaries, and if you have more than one child, and you certainly don't have to list your children as secondary beneficiaries, but if you choose to, you want to list your children separately. For example, you have three children, Tommy, Susie, and Joey, and you decide, I'm just going to list Tommy because Tommy's a good boy and I know that he's going to share that benefit with his siblings. Okay. Even if Tommy is a good boy and he does share that benefit with his siblings, if we're only paying the benefit to Tommy, it's all taxable income for Tommy, and you probably don't want that to happen. So you want to list each child separately, so that each of them are taxed on their own portion of the benefit. The second thing, you just never know. Maybe Tommy is a good boy, but maybe something happens and he chooses not to share the benefit with his siblings. The pension fund would have no control over that at all. So a couple of questions did come in. And one of the questions is again about the 60 certain. The 60 is the minimum. We subtract any monthly payments that the carpenter has received, and then the beneficiary gets any remaining payments. So if the carpenter's received 58 payments and then passes away, there are only 2 more benefit payments due to the beneficiary. There's a question about the joint and survivor benefits, and the question is saying that I also talked about a 60 certain. Someone thought that they're separate benefit options. The 60 certain is a separate choice from the 50% and from the 75% and from the 100%. But the 60 certain guarantee is also built into the 50, the 75, and the 100% options. So you pick one of the options, but on the 50, 75, and 100, if you and your spouse both pass away before you've received benefits totaling at least 60 payments, the balance of the payments due would be paid to your secondary beneficiaries. Okay. A question, can you name a trust as a beneficiary? Yes, you can name a trust as a secondary beneficiary if you want to, but you should really consult with an attorney about that. If you name a trust as a beneficiary, the pension fund is still going to pay out benefits on a monthly basis to that trust. So it may have the effect of keeping the trust open longer than you would want it to be open. So for example, if the carpenter chooses a 60 certain guarantee, the carpenter only gets 2 payments and then passes away. There are 58 payments due, and that would not be paid out to a trust in a lump sum. It will be paid out over the course of 58 months, which would mean the trust would have to stay open for almost an additional 5 years. Another question came in about pre-retirement death benefits, and we will talk about those as we get to those particular slides. Okay, so I am going to move on now, and we're going to talk about the partial lump sum estimate that's in your personalized packet. If you had a question that I didn't address, or something you didn't even want to type, something more complicated than you felt you could type into a little chat box, please remember you can always call the Retirement Benefits Department. We're happy to speak with you one-on-one about any questions that you have. Okay. So the next item in your personalized printouts has a capital C at the top right-hand corner, and it is called a partial lump sum estimate. Okay. If you printed out your handouts, I would urge you to put your 2 estimates side by side on your tabletop so that you can look at both sets of figures at the same time. The partial lump sum option became an option in July of 1995, and it is a way for you to take part of your monthly pension benefit as a lump sum up front. You still receive a monthly pension benefit, you just get a lesser monthly pension benefit because you will get a chunk of money up front in a lump sum payment. So on your personalized lump sum estimate with the C on the top of that form does the math for you. So I'm still carrying through with my example $4,950. On my example, this was the base 60 certain amount. So we take 10% of that, which is $495, and we take that $495 and we multiply by what's called an actuarial factor. Okay, our accountants and actuaries give us actuarial factors. I'm not even going to pretend to you that I understand everything that goes into the actuarial factors, but they have to do with things like life expectancy and interest rates, just to name 2 of the components. Okay. These actuarial factors change every July and at other times as mandated by federal regulations. Okay. The actuarial factors that you have listed there, even though your estimate may be for July or later this year, the actuarial factors that are used are the actuarial factors that run through June of this year. And that is because we don't have the new factors for next year yet. We don't get those until the end of June. So we take 10% of your base 60 certain amount. We multiply by the applicable actuarial factor, and we get a partial lump sum amount. So in my example, it's $93,536. If you choose the lump sum option, in your first month of pension, you will receive a partial lump sum payout along with your first monthly pension check. But your monthly pension check will be a lesser amount. So we take the base $4,950, your base 60 certain amount, and we subtract off $495, which is the 10% that we've converted into this lump sum factor, this lump sum payment over here. So that brings you down to an adjusted monthly pension amount of $4,455. So if you look on your personalized C estimate, about halfway down the page, you can see your adjusted 60 certain monthly amount if you choose to take advantage of the lump sum payment option. So in my example, instead of getting a monthly amount of $4,950, this carpenter will get a monthly amount of $4,455 because he's getting a lump sum up front of $93,536. Now, the lump sum that's quoted on your estimate is the maximum lump sum amount that is allowed. You are able to say Well, that lump, it sounds like a good idea. I would like to take part of my pension in a lump sum up front, make sure the mortgage is paid off, make sure the credit cards are paid off, make sure a few other things are paid off so I can go into my retirement free and clear, and maybe a little bit of money on a down payment on a home out in Arizona or Florida or wherever you envision your perfect retirement. But to do that, you maybe say, well, I don't really need that whole $93,000 that's here on the estimate. That's okay. You can choose to take a lesser partial lump sum. Okay. The minimum allowed is $1,000 and the maximum allowed is the amount listed on your estimate there, your 10% maximum. So if you're interested in another monthly amount, a lesser monthly amount, give the retirement benefits department a call and we can send out an estimate to you for a lesser monthly amount. You can kind of do the math backwards also. If you say, I'm thinking of a partial lump sum of $20,000. If you divide that $20,000 by the actuarial factor, you can back into your reduction over here. But if that math makes your head hurt, just give the retirement benefits department a call and we would be happy to send you out estimates for a lesser partial lump sum. Okay. So if you look down a little bit on your personalized lump sum estimate, see if I can. You see your adjusted monthly pension amounts. And that's why I like, if you've printed these, if you put them side by side, you can just kind of glance back and forth and you can see the impact on your monthly benefit amount for either the 60 certain, the 50%, the 75%. You can see the impact on that monthly benefit amount if indeed you choose to take the lump sum up front. Okay. Now, if you choose to take that lump sum up front, you need to decide what you're going to do with that lump sum up front. And I don't mean that you want to take it out and run out to Vegas and gamble, okay? Although that certainly is an option. But financially, you need to decide what you're going to do with the lump sum option. If you choose, you can roll that lump sum payment option. Excuse me, I missed a slide here. I went too quickly. On that lump sum payment option, the first option is to have that lump sum payment option paid directly to you. If that lump sum payment option is paid directly to you, it's added to your taxable income for the year, and the pension fund office is required to withhold 20% from that lump sum amount for federal income taxes. Just like the withholding on your paycheck, we have to hold back 20% of the lump sum for federal taxes if we are paying the lump directly to you. Please, this is very, very important. I am not telling you that the lump is taxed at 20%. The lump is going to be taxed at whatever your own personal income tax bracket is, okay? I am telling you that we need to hold back 20% to send to the IRS for your federal taxes. Your actual tax percentage is going to vary based on your own personal individual tax bracket. So you might end up paying more than 20% if you're in a higher bracket. You might end up paying less than 20% if you're in a lesser bracket. We're going to send that 20% to the IRS, and then you're going to deal with the IRS at the end of the year when you file your taxes as to whether or not you're owed a refund or whether or not you have to pay more than 20% regarding federal taxes. It's strongly recommended that you talk with a tax advisor or a financial advisor about all of your different payment options. While the fund office staff is happy to explain your options to you, we are not allowed to advise on what might be the best course of action for you. If you choose to, the lump does not have to be paid directly to you. You have the option of rolling over the partial lump sum option to a traditional IRA. If you choose to roll the partial lump sum option over to a traditional IRA, we pay the full amount of the lump to your traditional IRA. We don't hold anything back for taxes, and you become taxed on the money as you withdraw it from your traditional IRA. Okay, so it's not taxable in the year that we send it to your IRA, the traditional IRA. It's taxed as you remove it, as you withdraw it from your IRA. Our supplemental retirement plan, our John Hancock supplemental retirement plan that we'll talk about in a little bit, is also a vehicle that you could do a traditional rollover for. Even though it's not an IRA, it's considered a qualified retirement plan. So if you wanted to take that full lump sum, you have the option of rolling it also into your John Hancock supplemental retirement plan account. Your third option on the partial lump is you can roll it over to a Roth IRA. So for those of you familiar with Roth IRAs are post-tax vehicles. So if you choose to put this into a Roth IRA, it will be taxed in the year in which the plan sends it to your Roth IRA. We are required, again, to hold the 20% to credit against your federal income taxes. However, the money will not be taxed when you withdraw it from the Roth. So it's taxed before it goes into the Roth, and as you withdraw it from the Roth, it is not taxed. Okay. When you apply for pension, you will make your elections regarding the partial lump sum option. In the handouts, in the pension handouts, the form in the packet it starts on page 8 and it runs from pages 8 to 10. You tell us yes or no, you're interested in the lump or you're not interested in the lump, and if we're paying it to you or if you're rolling it over to an IRA. Also in that handout packet on pages P11 to P16, there's a federally required tax notice, which speaks to the different options of rolling the benefit over to a traditional versus rolling it to a Roth versus having the benefit paid directly to you. Okay. So we are going to take a break. During the break, if you have questions about any of the pension payment options, please send a chat with those questions and I will try and answer as many as I can. And then we will come back in 5 minutes. We're running a little bit longer than I thought we would be. So I'm going to do my best to get this in by 11 o'clock, but just a heads up, hopefully you can stay with us. We will probably go a little bit past 11 o'clock. This broadcast is being recorded and it will be posted on our website later in the week. So if you do have to leave us right at 11, you'll be able to pick up and watch it on our website. So it's 10:07 now. Let's come back and start again at about 10:13 or so. Thank you very much. Okay, we're back. Some questions that came in while we were on break. Some questions that came in while we were taking a break. Is the monthly pension taxable? Yes, the monthly pension is taxable. In your packet, there's a form for income tax withholding on the monthly pension. And the monthly pension is taxable because you have never paid taxes on the benefit. Your employer contributed to the pension fund on your behalf, but now it's time for you to pay taxes on the benefit. The benefit is federally taxable. Whether or not it's state taxable depends on the state in which you live. Currently, Illinois does not tax pensions. Whether or not that might change in the future, I'm not sure. I am not an expert on all of the different states. So on a state level, you would need to check with the state in which you are either living now or going to be, living during your retirement. Another question came in about union dues. Union dues are a local matter, and we always urge you to talk with your local union representatives about the union dues. Union dues are not deducted from your pension, so payment of union dues would still be between you and your local union. Keeping up your union dues allows you to continue to access your HRA card, which we'll talk about in the health benefits section. It also gives you access to all of the benefits available from the coalition benefits, and I'm sure many other things. But again, union dues are a local matter. They're not deducted from your pension check, so you talk with your local about keeping up your dues once you're retired. A question came in about if you don't have a printer, can the fund office mail you a hard paper copy of the handouts? Yes, we can. Give the Retirement Benefits Department a call next week and let us know that you need a set of those mailed out to you, and we would be happy to do that for you. A couple of personal questions came in about participants who have credit with both the construction and the Millman funds. It's called a limited pension. Please give the Retirement Benefits Department a call separately about those next week. It's a little too involved to go into on a webinar. With respect to the partial lump sum payment option, even if you pick the partial lump sum payment option, all of the payment options work the same as they do without the partial lump. So for example, the 50% joint and survivor benefit works the same on a partial lump as it does if you don't take the partial lump. And the 60 certain guarantee, as far as how the 60 monthly payments are made and due, that works exactly the same both with and without the lump sum. So how those payment options all work and the features of those are all the same. A great question, and I did forget to mention this, on the payment options that you pick when you start your pension, be it the 60 certain or the 50, the 75, the 100, that payment option cannot be changed once your pension is in pay status. Okay? So if you pick the 60 certain when your pension starts, and 2 years later you come back and you say, oh, I want to change to the 75%, we're going to say, no, you can't do that. Okay, so think about that when you're making your payment option selection. It is a permanent selection. The other thing that I need to mention is that under federal regulations, you must select at least a 50% joint and survivor benefit if you are married. If you are married, you must select at least a 50% joint and survivor benefit unless your spouse will sign a consent form to let you take the full 60 certain benefit for you for your lifetime. Okay, and that is a federal regulation, and of course the plan needs to comply with the federal regulations. So if you're married, at least a 50% joint and survivor benefit, unless your spouse will sign a consent form, and it's the plan's consent form that we would send out to you if you indicate you want the full pension, the 60 certain, with spousal consent. A question came in over the break also about cost of living increases. There are no guaranteed cost of living increases built into the plan. Okay. From time to time, the trustees issue an increase or maybe issue a bonus payment, but those are decided on an annual basis by the trustees. The trustees just had their May meeting, and I do not believe that anything was done as far as a bonus payment or an increase for the retirees this particular year. There was a bonus there last year in 2019, in the fall of 2019. There was a percentage increase, and the percentage that was received is based on how long a person was on pension. In 2017 and in 2018, there were bonus payments issued to the retirees. In 2017, it was equal to 1 monthly payment, and in 2018, there was a calculated bonus payment issued. So those, again, are decided on by the Board of Trustees on a month-to-month basis. Okay, I'm going to move on in the presentation. Again, just to revisit what I mentioned before the break, it is our first webinar. I didn't know how to judge the time. We are going to run past 11 o'clock. I can tell you that already by looking at the clock. So please remember the recording will be posted on our website. And our website, it's in the handouts on the phone number page at the beginning, but it is CRCC, like Chicago Regional Council Carpenters, benefits with an S on the end, .org, crccbenefits.org. So we will post the recording on our website. Okay, moving on. If you have not already done so, you should consider setting up your own personal Social Security account. Okay, you go to ssa.gov and you register. Okay, a couple of reasons why you want to do this. When you apply for pension, you will need to furnish us with a copy of your Social Security card. And on the Social Security website, if you have an account, you are able to request a Social Security card online. Okay. The second reason here is to get a personalized estimate of benefits from Social Security. How much are you going to draw from Social Security when you start drawing your Social Security benefit? It helps you with your financial planning. Okay. And the Social Security estimate looks like this. They used to come in the mail every year around your birthday, and now you can request them online. And for our next payment option, if you're interested in this payment option, you would need to submit a copy of that Social Security statement to the Retirement Benefits Department. The next payment option, I'm going to go through quite a few slides on a relatively quick basis here. It's not a terribly popular option, but we like to talk about it anyway, just to make sure everyone knows all of your options. This option is only available to the Construction Pension Fund. If you are a participant in the Millman Pension Fund, this option is not available to you. In order to take this, you would have to be at least 60 years old at the time you start your pension, and you have to have current pension credit, which means you have to have credit within the 3 years immediately prior to your retirement. Okay. So in the example that we have here, this particular participant is a participant in the Construction Pension Plan, and he is electing to retire and apply for pension at 60 years old. He's worked for 37 calendar years and earned 42 pension credits. So we calculate the base 60 certain amount, we take his 42 pension credits, and we multiply by the $100 benefit accrual rate, assuming that he's never had a 3-year break in service for calculation purposes. So we get a monthly 60 certain amount of $4,200. Okay. He sends us a copy of his Social Security estimate, and the Social Security estimate shows that at age 62, he would be entitled to $1,200 a month. So we take that $1,200 a month estimate from Social Security, and again, we have another book of factors from our actuaries, and we multiply by the actuarial factor that applies to his pension, his age at his pension start date. So we take his $1,200 Social Security, we multiply by 85.8%, and we come up with an amount of $1,029. To arrive at his monthly benefit amount, we take his base 60 certain amount of $4,200, and we add to it the level income amount that we just calculated on the last slide of $1,029, and we arrive at a monthly pension benefit of $5,229. So this particular member would get a monthly pension benefit from the pension fund of $5,229 from the time his pension begins until the time his Social Security benefit starts. Sounds pretty good, huh? Extra money, woohoo, sign me up. Okay. Well, as I like to say when we are in person at the seminar, there's no free lunch. Even though you will get additional money or extra money up front on a monthly basis from the time your pension starts until the time your Social Security kicks in, once your Social Security kicks in, the benefit from the pension plan goes down. So when the Social Security starts, we take the $5,229 that you were getting from the pension fund office, and we subtract off of that the full amount of your Social Security benefit. So the whole $1,200 from Social Security comes off the monthly benefit. And the fund office benefit that you're getting from the pension fund decreases from $5,229 down to $4,029 a month. Okay, so you end up, once Social Security starts, at a monthly pension benefit that is less than the monthly pension you would have been entitled to had you not elected this option. It's called a level income option because you're still getting the same amount on a monthly basis. So you're still getting $5,229 every month. It's just that Social Security is paying you $1,200 a month, and the fund office is paying you $4,029 a month. Okay. Along with the level income option, you can also do joint and survivor options. So you could also do a 50%, a 75%, a 100% benefit payment option. And if you're interested in the level income amount, please request your personalized estimate from the Social Security Administration. Send a copy to the pension fund office, and we can send you out your personalized level income estimates so you can look at your own individual figures. Okay, again, it's not a terribly popular option, but if for some reason you need to commence a pension benefit before 62, before you're eligible for Social Security, it might be a way to help you financially until the Social Security benefit kicks in for you. So something to think about. Okay. Our next topic is disability pension. Okay. It's a tough trade. I know it's a tough trade. You know, you're out there, you're working with the tools. A lot of people have difficulty with maybe their knees or their hips or a rotor cuff or something like that. So we do see a lot of interest in disability pension. In order to qualify for a disability pension from the construction pension plan, you need at least 15 years of pension credit. Or if you don't have 15 years, you'd need 10 years of credit and a quarter year of credit in the year you become disabled or one of the immediately preceding 5 years. On the mill plan, it's 10 years of credit and a quarter year of credit in one of the immediately preceding 2 years. Okay. For a disability pension, you need to meet the definition of disability under the rules of the pension plan. Okay. Disabled means that you are unable to engage in any substantial gainful work activity. It's not enough to be disabled just as a carpenter. Okay? You have to not be able to work at any type of employment. Any type of employment, being either physical employment, employment that requires mental activity, desk work, things like that. You have to be disabled for any type of activity, not just for carpentry. Gainful activity is work performed for profit. You're paid for it. And the gainful activity limit on a disability pension, we use the Social Security disability limit that changes annually, but it's $1,260 a month for 2020. Okay, so you can't work at anything that would give you substantial income. So the example I like to use is actually one disability pensioner that I personally knew for many years. He was disabled, he was unable to work, but he needed to get out of the house just a little bit. So literally 3 mornings a week, he baked the biscuits at McDonald's. He went and worked at McDonald's for a couple of hours in the morning, 3 days a week, just to get him out of the house. So that would not be considered substantial gainful activity. Okay. In order to prove disability, you have to submit to the pension fund either a copy of your Social Security Disability Award letter indicating that you're receiving Social Security disability benefits under Title II of the Social Security Act. Okay. Or if you do not yet have Social Security disability, you need to submit medical records that substantiate your claim of disability. You'd submit those medical records to the pension fund office, and we in turn send them out to an independent medical consultant for review. The medical consultant will determine whether or not you meet the pension fund's definition of disability. In the pension handout, disability information goes from pages P43 to page P47. The full language of the definition of disability is there, and you can see some of the forms that need to be completed in order to apply for a disability pension. What are the advantages of a disability pension? I don't even know if advantages are the right word, because if you're disabled, it's certainly not an advantage. But financially, from the pension standpoint, a disability pension, no matter what your age, is calculated as if you were 60 years old for the construction fund or 65 for the mill. So that means that there's no reduction for your age if you're younger than 60 or 65 if you're mill. The same options that we talked about on your personal estimates, the 60 certain guarantee, the 50, the 75, and 100, those are all available to disability pension. The partial lump sum option is available on a disability pension. The level income option is not available on a disability pension. Okay. The other thing that's different about a disability pension are the work restrictions. Okay. The work restrictions are different on a disability pension. So we're not looking at only the type of work. Again, I just gave you the example of the disability pensioner who worked at McDonald's a little bit. But on a plain old early pension or a normal pension, we're not looking at how much money you make. We're looking at the type of work you do. On a disability pension, we look at both. It has to be non-carpentry, non-building trade type of employment, and you must stay under the limit of $1,260 per month as determined by the Social Security Administration. Okay. If you have questions about disability pension or want to take a deeper dive into a disability pension, again, please give the Retirement Benefits Department a call. We'd be happy to walk you through that. If you just have a quick question here or there, give us a call. We'll talk to you on a one-on-one basis. If you feel like your situation is more involved, call and make an appointment. We are still taking appointments. Even though the fund office is closed, we are doing telephone appointments. So we can devote as much time as you need over a telephone appointment. Okay. So a question came in over the break that I didn't address right after the break because I knew I had a couple of slides that spoke about it. The question was about what happens if the carpenter passes away before pension starts. So on a pre-retirement basis, if the carpenter passes away, if the carpenter is married and has been married at least 1 year at the time of his death, on the construction fund, the benefit to a surviving spouse is paid as a pre-retirement 100% joint and survivor benefit. A surviving spouse does not have the option of the partial lump sum, so you would be looking at your personalized estimate, the one with the B up on top. If you look at the 100% joint and survivor benefit listed on there, that would be the monthly amount a surviving spouse would be looking at on the construction pension fund. On the Millman pension fund, it's a pre-retirement 50% joint and survivor benefit. So if the carpenter passes away prior to retirement in the Millman fund, it's a 50% joint and survivor benefit. That monthly benefit starts the month after the carpenter passes away, so the spouse does not have to wait to be a certain age. And it is a lifetime benefit for the surviving spouse, regardless of whether or not the surviving spouse subsequently remarries. Okay. If you are not married, but you are at least early retirement age, so that means you're at least 60 in the at least 55 in the construction plan, or at least 60 in the Millman plan, we pay a pre-retirement 60 certain benefit. So you'd look at your B personalized estimate. The 60 certain option on your personalized estimate would give you an idea of where you would fall with that. If you are not yet 55, to do the calculations on a pre-retirement 60 certain, we basically pretend like you were 55. So the early reduction factor that applies to someone who starts pension at age 55 would also apply to you, or actually to your calculation of your benefit for your beneficiary if you pass away prior to retirement. If you are not yet early retirement age and you are not married and you pass away prior to pension,
there's something called a death benefit that's payable, and that's calculated by taking your total years of pension credit and multiplying by a death benefit rate, and then your beneficiary would receive that monthly benefit in 60 monthly installments. I don't believe I saw anyone registered here that would apply to, so I'm not going to spend a whole lot of time on it. If I did miss it and it does apply to you, please give the Retirement Benefits Department a call, and we would be happy to speak with you about how that would work. Okay. Beneficiaries. We briefly touched on beneficiary forms. So I wanted you to have information on when your latest beneficiary forms were received by the pension fund office. So on your personalized printouts, the one with the D, like in David on the top right-hand corner, these show your beneficiary designation dates. The top date, the Welfare Fund Active Plan of Benefits form, that beneficiary, if you are actively eligible for the health benefits, that beneficiary form is for your Aetna life insurance. And actually Aetna now is the Hartford, but that's for your $50,000 life insurance policy that you have while you are still eligible for the active benefits. So you can see the date that you most recently designated a beneficiary for the life insurance. The second line down is for the construction fund pension beneficiary date. And then you have a Millman fund. If you are not a participant in the Millman fund, you don't need to worry about that date. Okay. And then the fourth one on the list is the date you've designated a beneficiary for the supplemental retirement plan. And then we've also given you your balance as of about a week ago or so, your approximate balance in the supplemental retirement plan. Okay. A word about beneficiary designations, especially on a pre-retirement basis. It is a good idea to have beneficiary forms on file. It just makes things go smoothly or more smoothly for your beneficiaries in the event something does happen to you. But there are provisions in the plan that exist in case you do not have a beneficiary on file at the time of your passing. If you are married, your surviving spouse is automatically your beneficiary. And then next in order would be any surviving children in equal shares. And then after that, it would be surviving parents in equal shares. So it is a good idea to have the forms on file, but I wanted you to know that you don't need to necessarily be panicked if there is no beneficiary date listed here. There are provisions under the plan. If you are not married, any children that you might have are automatically your primary beneficiaries in equal shares. Again, I encourage you to fill out the beneficiary forms and send them back. As far as the supplemental retirement plan balance, we'll talk about the supplemental retirement plan in a couple of minutes. You should be getting quarterly statements from John Hancock Retirement Plan Services, so hopefully everyone has a bit of an idea of your balance. We just thought that for purposes of the webinar, it would be nice for you to be able to have an idea of your balance. Okay. Once you are retired and receiving a pension benefit, upon your passing, there is a lump sum death benefit due from the pension fund. Okay. From the construction pension fund, there is a $3,000 lump sum death benefit. And from the Millman pension fund, there is a $2,000 lump sum death benefit payable. Okay. If you are someone who has credit in both the construction and the Millman fund, and you get pension checks from the construction and the Millman fund, you don't get both of these. You don't get a $5,000 combination, but you do get the $3,000. So you get the greater of the two benefits in case something happens to you once you are already receiving a pension. Your Aetna life insurance policy, your active working carpenter life insurance policy, the $50,000 that you have while you are still eligible for the active working carpenter insurance benefits, that stops at the time your active benefits end. And we'll talk a little bit more about active benefits ending once we get into the health care portion of the presentation. But for right now, since we're talking about death benefits, you need to know that that $50,000 Aetna policy goes away. Now, there is a new retiree policy that will come into play that we'll talk about in the health benefits section. But for right now, we're just talking about the Aetna benefit, the $50,000. You can, if you choose to, convert that to an individual self-pay basis. So in the handouts, in the pension handouts, on page P22, there's a chart in there that shows you what it would cost you, what the premium charge would be directly through Aetna, which again is now the Hartford. And those premiums are per $1,000 of coverage. So you don't have to pick up the whole $50,000 policy. You can pick it up in $1,000 increments. Aetna sets the rates. That conversion application you fill out would go directly to Aetna. Again, they've merged now with Hartford, and your premiums are paid directly to Aetna/Hartford. The fund office does not set those rates and does not really have anything to do with those premiums. It is certainly not mandatory for you to pick up this coverage, but we do like to let you know what the premiums would be if you choose to continue that coverage. Pension application. About half of you registered today indicated that you're ready to go. You're ready to file your pension application. This packet that you've received today, your personalized printouts and the handouts, those can be used as an actual pension application. So if you're really ready to go and you were able to print your paperwork, you can use this paperwork to apply for pension benefits. Pension applications are only good for 6 months. So this packet can be used as an application. If you are starting your pension, I would say I would go with October. You could probably push it and still use this packet for November, but it's not a good thing to be right up at that 6-month deadline. So if you're thinking of starting your pension by October, use this packet to apply. If you're thinking of going after October, maybe January of next year or the summer of next year or even later than that, give the Retirement Benefits Department a call and we can send you out an updated application packet, and you want to call about 3 months ahead for an updated packet. You want to file your application about 90 days in advance of the date that you want your pension to begin. There are a lot of federal regulations that govern when a pension can start and when all the paperwork needs to be provided to you. If you want to start your pension very soon and you're sitting there right now thinking, oh no, I don't have 90 days. It's still possible that we can get you in for, say, a July pension effective date. It's too late for June. June is closed already. But if you're thinking you want July, you should apply immediately, like next week. Give the pension fund a call if you have questions. If you think, oh no, I'm not at my 90 days, what do I do? Give a retirement benefits representative a call and discuss your deadlines in detail. Okay. I want to talk just briefly about an effective date versus an award date. An effective date is the date that you're first entitled to a pension benefit, and you have to apply in advance. So I say right now it's already too late for June because there are no more business days in May. You have to file an application at the absolute latest by the end of the month prior to the month that you want your pension to start. So Monday, we're into June, so you could be filing for July. But even though if you filed your application on Monday or Tuesday next week, you would be eligible for July pension money, but we're not going to have enough time to process your pension and get you a July award date. Now, the award date is the date that we issue your first check. And your award date is usually 60 days after we have everything completed from you. your pension application is turned in, all of your supporting documentation is turned in, everything. Okay. But the good news is that once your award date comes around, when we issue your first check can include retroactive payments for any payments that we might still owe you that were sort of in limbo while we were waiting to get all of your paperwork completed. Credit adjustments. So the estimates that are in your personalized packet right now, those estimates only include credit earned up to last week when we ran those estimates. If you're retiring for July 1st, just for example, let's say July 1st, but you're going to work all the way through the end of June, your June hours don't have to be received by the pension plan office from your employers until July 15th. Okay. So in some cases, your pension has started for July 1st, but on July 15th, we're getting in additional hours from your employer. So what happens is approximately 3 or 4 months after your pension starts, the Retirement Benefits Department automatically goes back and rechecks everyone's credit record. And if additional hours have come in for you, and that means extra credit has been earned on your behalf, we recalculate your pension amount and we give you an adjustment for any retroactive money that may be due to you. The full adjustment for any new credit is made to your monthly benefit amount. We do not go back and adjust the amount of a partial lump sum payment if you chose that option. Also, if you are age 65 and you are still working under that 39-hour rule and getting contributions, if you work 39 hours a month every month for the whole year, you're going to pick up an extra quarter year of pension credit. Or if you are 70 and a half and you are still working, you will pick up additional credit. Once a year, we adjust your pension benefit upward to account for any additional credit that might come in due to the 39-hour rule or due to being age 70 and a half and still working. Other information in the handouts. In the pension packet, on page P27, and that goes P27, 28, and 29. It talks about proofs of information required that you need to submit along with your pension application. Government-issued photo IDs, a copy of your Social Security card, which is another reason we suggest you register at myssa.gov. A lot of people can't find that Social Security card that's been hanging around for years. You have to send in proof of age, proof of marriage, in the form of county certified documents. So a church certificate or a synagogue certificate for your marriage is not acceptable. It needs to be a county certified document. For a birth certificate, again, a county certified birth certificate, not the little commemorative one that you have from the hospital that's got your footprints on it. Okay. Due to the current situation where the fund office is closed, we are temporarily accepting copies. Okay. And page 27 of the pension handout talks about that. So we are temporarily accepting copies of the county certified marriage document or of the county certified birth certificates. We recognize that a lot of people don't want to send their originals through the mail. So during this current situation where the fund offices are closed to outside visitors, you can submit copies. The packet also contains a construction fund pension application that's on pages 30 to 42. If you have credit with the Millman Pension Fund, a Millman application was emailed to you along with your personalized printouts. Direct deposit is mandatory on the monthly pension benefit, and it starts with the second pension check. Your first pension check must be a paper check, and that will be mailed out to you in the first month in which your pension starts, and it will include any retroactive payments that may be due to you. Circling back to taxability, that question that got asked over the last break, yes, the pension is federally taxable, and there is a tax election form enclosed with the application in the pension handouts. Finally, in the pension handouts, there's something called a relative value explanation. It's on pages 48 to 54 of the pension handouts. That summary is a really good summary of how all the different payment options work. The 50%, the 70%, all of those types of things. They're explained there. Or you can go back to our website and watch a rebroadcast of the webinar if you find that helpful. The estimates that you received when you apply for pension, you must sign and return both estimates, both the regular estimate and the partial lump sum estimate. We need to prove to our auditors that you've seen all of your pension payment options, and that you know what all of your pension payment options are, and that you made an informed decision about your payment option election. I will pause for a moment and give you a chance to ask some questions, and then we'll briefly talk about the supplemental retirement plan, and then we'll talk about retiree health benefits. So if you'd like to ask any questions about anything so far, we'll give you a minute or so to type. Okay, I don't see any questions coming through, so I'm going to move on. Reminding you again, please call the Retirement Benefits Department. Even though the fund office is closed to outside visitors, those retirement benefits representatives are still working, and they can assist you with your questions over the phone. So regarding the supplemental retirement plan, a lot of people call this a lot of different things, especially those of you who have been around for a while, as I have been. When it first started back in 2000, people called it the annuity plan, and then they called it the Putnam plan because Putnam was the previous record keeper. Then Putnam changed to Mercer. Then the title changed from the supplemental annuity plan to the supplemental retirement plan, and now John Hancock is the record keeper. So anybody talking about an annuity plan or my Putnam or my Hancock, we're all talking about the same thing. Okay? So as of June 1st, many of you might have heard this, but if you haven't, the contribution rate for the construction plan is going up to $8 per hour of service on the supplemental retirement plan. So that's there. Over the years, the rate has gone up and down. When the plan first started, the supplemental retirement plan contribution was $1.50 an hour. It went up to $2. It went down to $1. It went down to a low of 10 cents an hour after the stock market crash in 2008. But it's gradually been working its way back up. So as of June 1st, it'll be at $8 an hour for the construction plan. If you are out of the Millman plan, it depends on the collective bargaining agreement with your employer. So you can call the contributions department to double check on that. Once you retire, you are able to access your supplemental retirement plan, and there are other reasons where you could access that supplemental retirement plan before retirement. There are hardship reasons for things like extraordinary medical bills not covered by insurance, to purchase a principal residence, a house that you're going to live in, to avoid a foreclosure or an eviction, college tuition expenses for yourself or one of your dependents. So there are several other reasons, and I have not listed them all, that you could take a withdrawal out of the supplemental retirement plan. Those are all listed on our website, or you can give the fund office a call. Once you retire, you start your regular pension. Many people choose to access their supplemental retirement plan money at that time. You also might want to consider leaving the money in your account and withdrawing as needed. The service fees by John Hancock are really very low service fees and quarterly fees compared to some other investment options that are out there on an independent basis. You certainly don't have to leave it there, but it's something that you might want to consider. You can also elect installment payments on your supplemental balance. So you could take out installment payments on a monthly, quarterly, or annual basis. You can do a lump sum withdrawal of your supplemental retirement plan. And if you choose to do that, the same options are available to you for the supplemental retirement plan as would be available to you for the partial lump sum option that we talked about earlier in the presentation. So you can have the lump sum of your supplemental retirement plan paid directly to you. You can roll it to a traditional IRA. You can roll it to a Roth IRA. So you have all of those options that are available to you. If you're going to access your supplemental retirement plan account balance, you would get an application from John Hancock. You would call John Hancock at the phone number on your screen, or you can log into the John Hancock website and you can request forms there on the John Hancock website. Even though you request the application from the John Hancock website, you would return the completed application back to the pension fund office, to the retirement benefits department. We process the application in the fund office, and we direct John Hancock to distribute the funds in accordance with what you're asking for from the supplemental retirement plan. If you take the supplemental retirement plan balance out prior to retirement, you do a hardship withdrawal, for example, or you do an in-service withdrawal where you can access your money. If you take those types of withdrawals prior to age 59 and a half, the IRS will charge you an extra 10% excise tax at the time you work with the IRS, you file your taxes. So pre-59 and a half, there's an extra 10% tax penalty on a supplemental retirement plan distribution. There's one exception to that right now at this point in time due to the coronavirus. There is a distribution option. It's called a coronavirus distribution. You are allowed to take a one-time distribution out of your account of an account up to a maximum of $15,000. If you do that, the coronavirus distribution is not subject to that extra 10% excise tax penalty. So that's available. If you have questions about that, or if you're interested in that, give the Retirement Benefits Department a call next week and they can walk you through that. Okay, so we got through the pension section on the amount of time that I allocated for the whole presentation. So we're going to take another 5-minute break. I see a couple of questions have come through the chat pertaining to health benefits, and I will cover those when we get to the health benefits section after the 5-minute break. Again, I apologize that this is going longer than 11 o'clock. I hope that you're understanding that this is our first webinar, and I wasn't sure how long everything would take. So it's 10:59. Let's take a 5-minute break and come back at 11:05, and we'll go over the retiree health benefits portion of the presentation. Thank you very much. Okay, and we're back. I want to thank you all for your patience. It looks like only maybe 3 of you had to leave at the 11 o'clock deadline. So again, thank you for your patience with this, our first webinar. I'll know the timing a little bit better for our next webinar, and we will certainly be doing some more of these. So retiree healthcare coverage options. A lot of times when people come into the fund office, when the fund office is open to outside visitors, retiree healthcare coverage is the very first thing that they want to talk about. But at the seminar presentation here, the webinar presentation, we like to go through your money payment options first so that you know where you're at with respect to that. A couple of questions came in over the break about the level income option. I would urge you to give the Retirement Benefits Department a call at the fund office next week with respect to that. And a couple of questions about what's the phone number at the fund office. The phone number at the fund office is 312-787-9455. That's 312-787-9455. The Retirement Benefits Department is menu option number 4 if you want to talk to a retirement benefits representative. And again, my team in the Retirement Benefits Department, they're a great team. I'm sure that they can help you out with any questions that I haven't been able to answer. If you ask them a question and they don't know the answer, they will find out the answer and get back to you. Okay, retiree health care coverage. We are going to talk about eligibility requirements for health care. We'll talk about the premiums because everybody's always super concerned about how much the premiums are going to cost. Most of you registered today were still eligible for the active working carpenter benefits. So we'll talk about active eligibility versus retiree eligibility and how those impact on each other. We'll talk about postponing enrollment for coverage, and we will talk about the different types of coverage that are available, both before Medicare and after Medicare kicks in. So first off, are you eligible for retiree health care benefits? I'm sorry, I'm going to take one quick pause. I see a couple of questions are still coming in. I'm the one answering the questions by typing and by speaking, so I can't do both at once. When I get to the end of the presentation on the healthcare benefits, I'll go back and answer some of the questions that are still coming through via the chat. So if you please be patient, I promise I'll get back to you after I'm done talking about healthcare benefits. Thank you. Healthcare benefit eligibility. In order to be eligible for healthcare benefits, you must have at least 15 years of vesting credit. If you don't have 15 years of vesting credit, you can also have health benefits if you have 10 years of vesting credit and you have never had a 3-year break for calculation. So I'm just looking at the slide. I kind of said that backward from the slide. So you need 10 years of credit, provided you've never had a 3-year calculation break. If you have had a 3-year calculation break at some point in time, you need at least 15 years for retiree health benefits. Okay. So you might want to go back and look at your personalized A printout, which showed your vesting years on there. If you don't remember what your vesting years were, many of you registered today had more than the 30-year vesting level that's on the tiered. So in your health benefits handout, so now I'm switching handouts. Up till now, we were looking at the pension handout. We're switching over to the health benefits handout now. This chart is on the first page of the health benefits handout. Retiree health care premiums are based on the number of years of vesting credit that you've earned. Okay? So if you go back and look at your personalized A printout, you can see how many years of vesting credit you've earned. So over here, you look at how many years of vesting credit, you find your years, and you follow it across. Okay. This second column here is the monthly premium for Blue Cross Blue Shield for people that are not yet on Medicare eligible. And this third column here is the monthly premium for Blue Cross Blue Shield for people that are Medicare eligible. The final column over here is the monthly premium for prescription drug coverage. So for someone with 30 years of pension credit, 30 years of vesting credit, who is not yet Medicare eligible, Blue Cross Blue Shield is going to cost $187 a month if you're not yet Medicare eligible. If you are married and your spouse is also not yet Medicare eligible, you will each pay $187 a month for the Blue Cross Blue Shield. If you are Medicare eligible, or if your spouse is Medicare eligible, you would pay $47 a month instead of $187 a month for the Blue Cross Blue Shield. So the first column here where I put this check mark and the second column here where I put the X, both of those columns are for Blue Cross and Blue Shield. The check mark column is how much you pay if you're not Medicare eligible. The X column is how much you pay if you are Medicare eligible. So if you, the carpenter, are not Medicare eligible, you pay $187. If you're married and your spouse is Medicare eligible, you'll pay $47 a month for your spouse. And then if you want the prescription drug coverage, you pay $75 each. So your premium is $187 plus $47 plus 75 times 2. So you're going to have to do a little bit of math to figure out what your actual premium is. If you still have dependent children, you can continue to cover your dependent children by the retiree plan up to age 26. You would pay a premium for each dependent child, also based on this chart. Okay. I sometimes feel like it's a little bit of sticker shock when people see this chart, especially for those of you who have consistently worked over the years. You've always been eligible for the active medical benefits, and now it's time to retire, and you see these premiums here. I urge you, if you think these premiums are expensive, I urge you very much to go out into the marketplace and to price comparably situated plans with coverage like this. These premiums are much less that you're going to find out than you will find out in the marketplace. The plan does not make any kind of a profit on this. In fact, these premiums are actually subsidized by the active working carpenter hours. If you are someone who falls into this 30-year tier, who has 30 or more years, your premium is subsidized by the active hours by about 75%. So this premium is really only about 25% of what coverage costs. Okay, and that subsidy rate goes down as your number of years of vesting credit go down. But even at the 10-year level, the 10-year vesting credit level, these premiums are still subsidized to the tune of about 40%. So these premiums really, even though you're looking at it thinking, oh goodness, now I have to pay that much for coverage, these are very reasonable premiums. Overall, across the entire plan, only about 30% of what the plan pays out in retiree medical and prescription expenses, only about 30% of what the plan pays out in claim payments is covered by the premiums. The other percentage of money is indeed subsidized by what is paid by the active working carpenter hours. The premiums that are here have been static. They have not changed since 2011. So your board of trustees appreciates the fact that you're not used to paying for coverage if you've been an actively working carpenter for all of these years. And they do everything they can to keep these premiums low. I would assume at some point in time that the premiums will need to increase. I don't know when that will be or by how much that will be. The trustees do look at this on a year-to-year basis. So we'll see what happens. They just had their May board meeting and there was no change to the premiums, at least for the present time. They can debate, they can discuss this and make decisions at any time where it's necessary. But I think the fact that the premiums have not gone up since 2011 speaks to the fact that your trustees really understand that how much you need to pay for health care coverage certainly has a big impact upon your retirement. If you are actively eligible, and if you have that HRA card, about a year and a half ago, you started getting contributions into a health reimbursement account. CYC, a company called Connect Your Care, is the record keeper for the HRA. If you have an HRA that still has a balance, provided that you stay a member in good standing with your local, you keep up your dues with your local, you can continue to use that HRA into retirement. You can use that HRA for co-payments, for deductibles, and even to cover these retiree premiums. Okay. What has to happen with the retiree premiums, if you want to use your HRA card for those retiree premiums, you still pay the retiree premiums because these premiums are going to be deducted from your pension check, but we send you a receipt and you apply to CYC to get reimbursed directly back for the cost of your retiree premiums. Okay. The elections that you make as a retiree are independent elections. So these first two columns, or the checkmark column and the X column here, are for Blue Cross Blue Shield, and the right-hand column is for prescription drug coverage. These are independent elections. So if you chose to, you could pick the prescription coverage and not take the Blue Cross Blue Shield coverage, or vice versa. You can take the Blue Cross Blue Shield coverage and not take the prescription drug coverage. Okay, they're independent elections. You don't have to elect both. We'll also talk about vision and dental in a later slide. Vision and dental are available to the retirees now, and there are separate premiums for vision and dental coverage. All four items, Blue Cross Blue Shield, prescription, and vision and dental, they're all separate independent elections. You don't have to take it as a package. However, in order for a spouse or dependent children to be covered by a certain type of coverage, the carpenter needs to be covered. So if you want prescription drug coverage for your spouse or for any dependent children, the carpenter must also elect prescription drug coverage. The same thing applies for the vision. If you want your dependent kids or your spouse to have vision, or even dental for that matter, the carpenter has to have the coverage in order for the spouse and the children to have the coverage. It doesn't work the other way around, though. If the carpenter has the coverage, the spouse and the children do not have to take the coverage. So it is possible, for example, for the carpenter to have prescription drug coverage, but for the spouse or the kids not to have prescription drug coverage. It's not possible in reverse. So the spouse and kids can't have prescription coverage if the carpenter doesn't have prescription coverage. And I'm only using prescription as an example. That applies the same way with the Blue Cross Blue Shield and with the vision and with the dental. The carpenter has to be covered for the spouse and the dependent children to follow along. Okay. And again, dependent children can be covered up until the age of 26. Okay, so when does your retiree health benefit coverage start? Okay. So this next slide, the slide I have up right now, is talking about what happens if you're not eligible for the active benefits when your pension starts. Okay. If you are not eligible for the active working carpenter plan of health care benefits when your pension starts, then your retiree health care coverage, if you're eligible and if you choose to elect the coverage, that benefit will start on your pension award date, the date that we issue your first pension check. If you are not eligible, your pension coverage, your health benefits start when you get your first pension check. Your premium will be deducted from your first pension check. Okay. So if you think back when we were talking about the pension section, I talked about an effective date versus an award date. On your pension, maybe your pension is effective for June 1st, but you don't get your first check until July 1st. Your health benefits start when you get your first check. The health benefits do not go retroactive. So that's another reason to file your pension application at least 90 days in advance so that we have time to process everything and you don't have to worry about the health benefits not being retroactive. Okay. Again, what I'm talking about here is if you're not eligible for active benefits when your pension starts. The majority of you who were registered for the webinar today are currently eligible for the active plan of benefits. So if indeed you are eligible for the active plan of benefits when your pension starts, even though your pension is starting, you're going to stay covered by the active plan of benefits until your hours run out. You want to stay covered by the active plan of benefits as long as you can because you don't pay a monthly premium for the active plan of benefits. The retiree plan, as we just saw, you do pay a monthly premium for. So if you are actively eligible for the active healthcare benefits when your pension starts, you'll keep that active eligibility. When your hours total falls below 1,000 hours for the past 4 quarters, then your eligibility for active benefits ends. When your active benefits end, you have 2 different options for what happens next. The first option, you can move right from your active benefits directly onto the retiree plan of benefits. So for example, if you retire on July 1st, but you have active eligibility all the way up until the end of November, even though you're getting a pension check, you've started your pension July 1st, you still have your same active working carpenter insurance for July, August, September, October, and November. Okay. If your active eligibility is going to end on December 1st, we could then move you directly from the active benefits on option 1 here, right from the active benefits direct to the retiree benefits. You'd move on to the retiree benefits. In my example, that your active eligibility goes to the end of November, your retiree benefits would start December 1st, and we would start deducting from your pension check the applicable retiree premium on December 1st. We would not do any deductions for retiree premiums from your pension check until after your active benefits ends. Okay. Your second option is to move from the active benefits onto COBRA for 18 months and then come to the retiree benefits. Now there's this kind of mystique around COBRA. People think, COBRA, what's COBRA? All COBRA is the name of a law. The abbreviation COBRA, the COBRA, it stands for the Consolidated Omnibus Budget Reconciliation Act. It's just the name of the law. It's nothing special. It's nothing mysterious. What that law says is that when anyone loses their active working insurance, be they a carpenter or be they somebody working out in corporate America, they have the opportunity to pay a premium and buy their active working carpenter insurance back. So you keep your same exact benefits that you have under the active plan of benefits if you choose to buy COBRA for 18 months. 18 months by law, under this law, is the maximum. And then after that 18-month period on COBRA, then you would move to the retiree benefits. And that's represented by option 2 here. So you could go from active benefits, you buy active COBRA benefits, and then you move to the retiree benefits. So the premiums for the active COBRA benefits, they're in the health benefit handout. They're in the health benefit handout on page H3. So for COBRA, to keep your vision and your dental, your whole plan of benefits that you have under the actives, the COBRA runs $581 per person per month. You could also take COBRA but not include vision or dental, and then that premium runs $528 per person per month while you're on the COBRA. Okay. You pay that benefit to the health benefit. You pay that premium, the COBRA premium, to the health benefits department at the fund office. 18 months is the maximum number of months you can take COBRA. You do not have to stay on the COBRA for the full 18 months. So maybe you're in the middle of some particular health benefit treatment or dental treatment and you want to keep coverage under the active plan, but you only need to take COBRA to do that for 3 months or 6 months. You can certainly do that. So you can go from the active benefits. You can buy the active benefits under continuation coverage under COBRA for maybe 3 months or 6 months. And then after that period of time is over with, then you come to the retiree benefits and you start paying a premium from the retiree benefits after the continuation coverage under COBRA ends. Okay. So you're not going to be paying a double premium. Okay. You exhaust your active benefits and go right to retiree, or you go from active to COBRA to retiree. Now you also have the option of extending your active eligibility through self-payment of hours. That became an option a little over a year ago. If you're short just a few hours to be eligible for the next quarter of coverage, you can buy hours under the self-payment option. I am not an expert in that option. I know it exists because we have to, know that it exists as a fund employee. But if you have detailed questions about how the self-payment of hours works, you should give the active benefits department, the insurance department at the fund office, a call. Their phone option number 3. Pardon me. One moment. Ooh, too much talking. My throat's a little bit dry. Let's see. Even though your retiree benefits, if you're eligible still for the active plan of benefits, even though your retiree benefits won't start until the active plan of benefits ends, you still complete the enrollment forms at the time you fill out your pension application. So if you look in the health benefit handouts, there's a sample enrollment form on page H5 and H6. And on the sample enrollment form, you can see that you choose the comprehensive medical benefits. That's Blue Cross Blue Shield. You make a choice for that. You make a separate choice for prescription drug benefits. You make a separate choice for dental benefits. And you make a separate choice for vision benefits. So there's different symbols on the election form. The circles are Blue Cross Blue Shield. The squares are prescription. The diamonds are dental. And the triangles are vision coverage. So each of those benefits are elected separately. Okay. And again, you fill out those retiree health benefit election forms at the time you apply for pension, when you submit your pension paperwork. Even if you're still going to be eligible for the active plan of benefits for a while, you still fill out those forms when you apply for pension. Okay, very important. Please, please, please notice this. Active plan deductibles and out-of-pocket maximums do not carry over from the active plan to the retiree plan. This is something that's not understood or not known about, and for years now I've been making a point at the seminars, the in-person seminars, to basically beg people to pay attention to this. So for example, if you have your active coverage benefits, and your active coverage benefits are going to run all the way up until the end of August, say you're retiring in July, and your active benefits are going to run up until the end of August. If you've already met your deductible or your out-of-pocket maximum on your active plan of benefits from January through August, and then your active plan of benefits end on September 1st, and you move to the retiree coverage for September 1st, you have to meet a new deductible and a new out-of-pocket maximum when you move to the retiree coverage. Okay, so just be aware of that. By no means am I suggesting you should forego any needed medical treatment that you might have. But if this is your scenario where your active coverage is ending September 1st, if you have an elective surgery that is not going to hurt in any way, shape, or form for you to put off until October, you might want to think about that, because even though you have to meet a new deductible on the retiree plan, just like your active plan, any deductible you meet in the last 3 months of a calendar year, so any part of a deductible met in October, November, December of 2020, a deductible met in October, November, December of any year will carry over and satisfy your deductible for the next year. Okay. Whereas anything you pay toward a new deductible, a retiree deductible, during the month of September, in my example, is not going to carry over until the next year. Now, just to be clear, if you need medical attention in September, you go get that medical attention, because there's no way it's worth endangering your life or your family's life just to wait for a deductible. But just be aware that this is a thing. It's been appealed, and appeals have never been granted on this subject. It's very clear in the plan provisions. So I feel like I'm harping on this a little bit, but from years of experience, I know that a lot of people don't understand this. So please, if you take away one thing about your retiree health insurance, please remember this from the webinar today. Your active coverage, you have behavioral health and substance use disorder coverage through ComPsych, and you have radiology and imaging coverage through Absolute Solutions. On the retiree plan, we do not use the ComPsych or Absolute Solutions network. You do still have coverage for behavioral health, substance use, radiology, imaging, but it's all through your comprehensive major medical at Blue Cross and Blue Shield. So it all falls under the Blue Cross Blue Shield umbrella, and it's subject to your deductibles and your co-payments on the Blue Cross and Blue Shield. Okay. So what happens if you don't elect coverage at the time you retire? Okay. You can postpone coverage under the retiree plan, provided that you have coverage through another health care plan. So maybe you, the carpenter, are retiring, but perhaps your spouse works outside the home and your spouse has coverage with the spouse's employer. And perhaps you, the carpenter, are also covered by the spouse's employer. Or maybe it's not even employer coverage. Maybe you buy your own coverage through the marketplace. Okay. As long as you have other coverage through another healthcare insurance company or employer plan, you can postpone your retiree coverage until that other plan ends. It has to be continuous coverage through the other plan, and the retiree health care benefits have to begin immediately following the termination of coverage under the other plan. So if your spouse is still working outside the home for maybe 2 years after you retire and the spouse puts you on coverage through the spouse's employer, both of you can come back to the retiree plan after the spouse's employer insurance ends. Okay. But you have to come back immediately following the termination of the other coverage. You can't wait 6 months and then say, oh, I want to come onto the Carpenters plan now. Okay. There cannot be a gap in coverage. Now, there cannot be a gap in coverage immediately prior to the retiree plan starting. There is an exception to the gap in coverage. It's a very small exception. It's on page H12 of your health benefit handouts. If your spouse, for example, has you covered and then changes jobs, and maybe due to that job change, there's a period of time where you're both not covered for 20 days or 30 days or whatever it might be. That type of a very small gap is permissible if it's due to a change in coverage. Okay, but that type of a gap cannot proceed when you immediately start the retiree plan. And if you want details on that rule, please give the Retirement Benefits Department a call and we can talk with you on that on a one-on-one basis. Okay. It looks like some folks have typed some questions in, so if you give me a second here, I'm just going to look at what kind of questions have come in, and then we'll talk about coverage options. So there's a question about the HRA card, and yes, you have to remain a member in good standing with your dues in order to use the HRA card. We're going to talk about the vision and the health centers out in Lisle. Most of you who are actively eligible are familiar with the fact that at the Lisle campus, there's a health center that you can use without any deductibles or copayments. And there's also a new vision center. In order to use the health center as a retiree, you must enroll in the retiree Blue Cross and Blue Shield coverage. In order to use the vision center out in Lisle, you must enroll in the retiree vision coverage. If the Carpenter takes coverage right away, and that coverage could be Blue Cross Blue Shield coverage, it could be prescription coverage, it could be vision, it could be dental, the spouse can enroll later on. The spouse can enroll a year or two later, provided that the spouse has had coverage through another insurance company, another healthcare provider, employer, or personally purchased. The spouse and even the children can enroll at a later date. The health benefit premium, the retiree premium, must be deducted from your pension check. Okay. We have a few people, a very few people, that don't have that premium deducted from their pension check because, and only because, their pension check is less than their health benefit premium. Maybe they have a number of dependent children covered, and maybe their pension is calculated at an old benefit accrual rate. But if your pension is not enough to cover your premiums, then you can submit payments to the fund office. Absent that situation, your premium must be deducted from your pension check. The question is, if you are not covered by the active plan of benefits when your pension starts, can you still have the retiree health benefits? And the answer to that is yes, provided that you have enough years of vesting credit in order to qualify. There's a couple of personal questions here about advantages of retiring at one age versus another. I would urge you to call the pension fund office to discuss those questions with the retirement benefits representative. Okay. So that looks like where we're at with questions right now. Again, if I didn't get to your question or a couple of the questions typed in are a little too complex to go into over a webinar, please call the retirement benefits department. I see that most of you have stuck around, so we're getting toward the end. We're just going to talk about coverage, and I do appreciate your patience. And I am so sorry that this is running much longer than I thought it would. So the comprehensive medical benefits. This is Blue Cross and Blue Shield. And this is for the benefits for the individuals who are not yet Medicare eligible. Okay. On the retiree Blue Cross and Blue Shield coverage, just like under the active plan and under most insurance plans out there in the world, you have an annual deductible. Your annual deductible is $300 per person for a PPO provider. If you use a non-PPO provider, you have a separate, that means an additional deductible of $600 per person. Your coverage under the retiree Blue Cross and Blue Shield, if you are not Medicare eligible, you're covered at 80% of usual and customary charges. Okay? If you're using a PPO provider, that PPO provider is only going to charge what the usual and customary rates are in accordance with that PPO contract that that provider has with Blue Cross and Blue Shield. You have an annual out-of-pocket maximum for your coinsurance of $2,000 per person. So that means if at any point in the calendar year The 20% that you have to pay out of pocket adds up to $2,000. The 20% that you have to pay out of pocket, if at some point in the calendar year that adds up to $2,000, the coverage increases by the plan from 80% up to 100% for the balance of that calendar year. Okay, so it doesn't always stay at 100% for the rest of your life, but for the balance of that calendar year, you'd only have a $2,000 out-of-pocket maximum. So that means that your individual liability in any given calendar year is $2,300, $2,000 for your coinsurance max and $300 for your deductible. Plan coverage would go up to 100% for the balance of that calendar year. Emergency room copayments. If you go to the emergency room and you are treated and released and sent home, you have a $250 copayment for an emergency room visit. That copayment is waived if you are admitted to the hospital direct from the emergency room, or if you go back to the hospital and are admitted for that same condition within 72 hours, the $250 emergency room copayment can be waived. So that's basic coverage pre-Medicare. Once you become Medicare eligible, Medicare is going to be your primary carrier. And the fund office, Blue Cross Blue Shield, turns into a secondary payer to your Medicare. Okay. For a lot of people, again, Medicare is kind of like Cobra. It's this mysterious thing. What is Medicare? I hear everybody talk about it, but what does it cover? Medicare is divided into two different parts. Medicare Part A covers the hospital facility charges. Medicare Part B covers the professional fees, what the doctor charges to see you in his office, what the surgeon charges to do the operation. Okay, so those are the two major differences between Medicare Part A and Medicare Part B. Medicare Part A, that's the part that pays the hospital facility or the skilled nursing facility, something like that. Medicare Part A is free for most people. That means you do not pay a monthly premium. You do not have to pay a monthly premium for Medicare Part A for most people. It's based on your number of years of credit with Social Security. I believe if you have at least 10 work years in, Medicare Part A is free, but you could certainly verify that through Medicare. Okay. So the Medicare Part A, that's going to cover the hospital facility charges. Even though for most people it's premium free, it's not deductible free. So if you are admitted to the hospital before Medicare starts to pay, there's a Medicare Part A deductible. For 2020, that Medicare Part A deductible is $1,408. The retiree plan of benefits pays the Medicare Part A deductible. So your retiree Blue Cross Blue Shield, that's your Medicare supplement, will pay that Part A deductible. You do not have to pay that deductible. That deductible covers your first 60 days of care. Nowadays, it's extremely unusual for anyone to be in the hospital for more than 60 days. But if you are, Medicare has a copayment per day from the 61st to the 90th day of $352. Your retiree plan of benefits is going to pay that copayment. Okay. So between Medicare paying and Medicare pays 80%, the plan supplementing 20% and covering your copayments. On the Medicare Part B, that's the part that pays the doctor bills, the surgeon bills, the professional fees. There is a Medicare Part B premium. So every month you are going to be charged a Medicare Part B premium of approximately $144 a month. If you're receiving a Social Security check, Social Security is going to deduct that $144 a month from your Social Security check every month. Okay. But the good news is, even though Medicare is charging you $144 a month, If you think back to our retiree chart that we had with all the vesting years and all the tiered levels, for someone who has 30 or more years of service, your Carpenters premium for the Blue Cross Blue Shield pre-Medicare is $187 a month. But once Medicare kicks in, that $187 a month you're paying for Carpenters Blue Cross Blue Shield goes down to $47 a month. Okay, so your Carpenters premium will go down from $187 to $47 a month, which is $140 a month difference. But you will start paying Social Security $144.60 a month for your Medicare Part B. So it's almost a break even on the premium cost. It just changes. Instead of paying the greater premium to your Carpenters Blue Cross Blue Shield, you pay the $144 to Medicare, and then you pay the lesser premium on your Blue Cross Blue Shield Carpenters supplement. Also on the Medicare Part B, you have a deductible. The Medicare before Medicare Part B is going to start to pay the professional fees, the doctor bill, things like that. You have a $198 deductible on the Medicare Part B. Effective this year, 2020, this is the first year the plan pays that Medicare Part B deductible. So you do not need to worry about paying that $198 deductible. Your Carpenters Blue Cross Blue Shield Medicare supplement will pay that deductible. Okay. After the deductible is satisfied, your Carpenters Blue Cross Blue Shield Medicare supplement is going to pay secondary to Medicare. So Medicare is going to pay 80% of the approved amounts, and then the plan is going to pay the remaining 20% of the Medicare approved amounts. So as long as you're using a provider that accepts Medicare assignment, you have really good coverage as a Medicare supplement. Most services are going to be covered. As long as Medicare covers something, your Carpenters Blue Cross Blue Shield Medicare supplement is going to pay secondary. Prescription drug coverage. Retirees, as do the active Carpenters, have prescription drug benefits. Okay? Those prescription drug benefits are through Express Scripts, and the benefits are almost identical to the active plan of benefits. At retail, you can have a maximum of 3 fills at your local retail, Walgreens or CVS or whatever pharmacy you use for long-term medication. They used to call it maintenance medication, something you take on an ongoing basis. So that's your cholesterol medication, your blood pressure medication, your diabetes medication. Things like this, you have to use the mail order program. It's mandatory to use the mail order program for long-term medication once you've gotten 3 fills at a retail pharmacy. Okay? Through mail order delivery, you get a 90-day supply of your medication delivered right to your house. You can even sign up for auto refills that you don't have to worry about remembering to refill your medication. Express Scripts will ship you your new set of medication when it's time for that to happen. You have some out-of-pocket maximums on the prescription drug benefits that are separate from your out-of-pocket maximums on your Blue Cross and Blue Shield. So you have $1,500 for specialty, single source, and multi-source, each separately. And we'll talk about what those 3 different types of coverages are. So this next chart is the coverage chart for prescription drug benefits. If you are taking a generic medication, and if you get that filled at retail, you have a $5 copayment. So you're sick and your doctor says you need an antibiotic prescription, and you take that antibiotic prescription over to your CVS or your Walgreens or whatever your drugstore is. If there's a generic available, it's only going to cost you $5 for that prescription at retail. Okay. If you're taking a generic of blood pressure medicine or cholesterol medicine, some type of a long-term medication, and you're using the home delivery, you have a $12.50 copayment for a 90-day supply with home delivery. On a single source brand, that means a generic does not exist. You have a 20% copayment. At retail, a $10 minimum and a $100 maximum, and mail order a $25 minimum and a $250 maximum for that 90-day supply at home delivery. If you're taking a multi-source brand, and that means that a generic version of the drug exists, but you're taking the brand name version of the drug for any reason whatsoever, you have a 35% copayment, $20 minimum at retail, $50 minimum at home delivery. The last category of drugs are called specialty drugs. Those are generally injectables, and they're pretty exclusive. They're used for things like cancer treatment, treatment of multiple sclerosis, different things like that. Rheumatoid arthritis, some of those types of drugs. Those are typically injectables that require special handling, and they're extremely costly. There's one specialty drug medication called Sovaldi that's used to treat hepatitis C. That drug costs $1,200 a day. So the specialty drugs are very expensive. There are a new provider for specialty drugs. We used to use a company called Diplomat, and now we've switched to a company this year called Accredo Specialty Pharmacy, and Accredo is affiliated with Express Scripts. Specialty drugs are only available through home delivery, and you get a 30-day supply for a copayment. You have a 20% copayment with a $20 minimum and a $100 maximum. So that maximum might seem like a lot for a 30-day supply, but when you consider the cost of some of these specialty drugs that can be really expensive, that $100 is usually very, very low considered when you take into consideration the cost of the drug, the entire drug itself. Retiree dental coverage. In the handout, the coverage chart is on page 23, H23 of the health benefit handout. For years, retirees did not have vision or dental coverage. Dental has been an option for 3 years now, and vision has been an option for 2 years now. And the way the plan is able to do that is that these benefits are insured benefits. So Delta Dental sets the premium for the dental coverage, and all we're really doing is holding a premium out of your pension check and passing that along to Delta Dental for you. Delta sets the coverage for the dental coverage, and Delta makes the payment on the dental coverage to your provider. So these are the premiums for the dental coverage. One person enrolled, that would be just the carpenter, is $44.53 a month. A carpenter with a second person, which could either be a spouse or the second person might be a dependent child if you're not married or if you don't have your spouse enrolled, that's $86.42 a month. And then a family of 3 or more, which would be the carpenter plus 2 or more other individuals, is $153.33 a month. Again, that premium is deducted from your pension check. The pension fund office forwards that to Delta. Retiree vision coverage, we have VSP, just like the active plan. On page 26 of the health benefit handouts, there's coverage charts, and you can refer to the coverage charts for the vision coverage. The biggest difference I can think of off the top of my head between active and retiree vision is that frames for glasses are covered under your active plan once a year. On the retiree plan, and again, you have the coverage chart, but on the retiree plan, your frames are only covered every second year. You can get lenses every year, but your frames are covered every second year. Separate vision premium is required, again, deducted from your pension check, and we send that premium along to VSP. VSP is the company that maintains the coverage, and VSP is going to pay your vision provider when they submit a claim. So one person enrolled, that would be the carpenter, is $620 a month. two people, which could be a carpenter and a spouse, or a carpenter and a dependent child if a spouse isn't covered, is $11.96 a month. And a family, which would be the carpenter plus two or more individuals, is $18.22 a month. Retiree hearing benefits. The hearing benefits are actually a component of the retiree Blue Cross and Blue Shield. So in order to be covered by the hearing benefits, you must be covered by the Blue Cross Blue Shield, the retiree Blue Cross Blue Shield, under the comprehensive medical or under the Medicare supplement with Blue Cross Blue Shield. So the hearing benefits were improved last year. Previously, we did not cover the exam, but starting last year, we started covering the hearing exam at up to $150 every 2 years. Hearing aids are also covered. The coverage limit used to be $1,500. That benefit was a big improvement last year when the hearing aid benefit went up to $5,000 once every 5 years. Now, hearing aids are really expensive. The $1,500 really, it wasn't enough. $5,000 still might not be enough depending on your hearing aid, but the hearing aid that your provider prescribes, but it's still a big adjustment upward, a big benefit improvement from where we were at before. We suggest that you utilize the Epic Hearing Network when you're getting your hearing aids. You get bigger discounts by using the Epic Hearing Network. Okay. It is not mandatory to use the Epic Hearing Network. Claims for hearing coverage are submitted to Blue Cross Blue Shield, and Blue Cross Blue Shield processes those claims. Additional benefits covered by the retiree Blue Cross and Blue Shield. You have a chiropractor, acupuncture, and napropath benefit. For a participant, a maximum of 50 combined visits a year, a spouse 30 combined visits a year. That benefit is not available to dependent children if you have dependent children covered. Also, you have Health Dynamics. As an active carpenter and under the retiree Blue Cross Blue Shield, you can have a Health Dynamics physical evaluation once a year for the participant and the spouse. That applies to people both before and after Medicare, so it doesn't matter if you're on the comprehensive medical Blue Cross Blue Shield or if you're on the Medicare supplement Blue Cross Blue Shield. The Health Dynamics is not available to dependent children. Benefit improvement last year for a retiree covered by the Blue Cross Blue Shield who passes away prior to age 65, age 65, who passes away prior to age 65, there is a $25,000 life insurance benefit for the retiree. It's insured through Aetna, which is now the Hartford, so kind of just like your active insurance, but it's a $25,000 benefit. It's not the $50,000 benefit under the active plan of benefits. And this benefit is only for the retiree, for the carpenter. There's no life insurance benefit for a spouse or dependent children. I would like to emphasize that for this benefit to apply, the participant, the carpenter, must be covered under the Blue Cross Blue Shield Comprehensive Medical or the Blue Cross Blue Shield Medicare supplements. Okay, that's very important. I mentioned this briefly before. We have the Carpenter Centers for Health and Vision out at the Lisle campus. As a retiree, as long as you are enrolled in the Retiree Comprehensive Blue Cross Blue Shield or the Medicare supplements, you are eligible to use the Health Center in Lisle. And as long as you are enrolled in the vision coverage, you are able to use the Carpenter Center for Vision in Lisle. This change happened last year. This is a huge change. Drum roll, please. Sound the trumpets. Effective January of 2019, a surviving spouse can continue with the carpenter's health benefits at the same premiums that the retired carpenter paid. The surviving spouse can continue on this coverage for the surviving spouse's lifetime. Okay, that was a huge benefit improvement that your trustees put through last year. Prior to this, coverage for a surviving spouse ended at the end of the month in which the retired carpenter passed away. This is true no matter what pension payment option you take on the pension money. So even if you took a 60 certain and you did not take a monthly benefit for a surviving spouse under one of those 50, 75, or 100 joint survivors, your surviving spouse can still continue the retiree health benefits. If the surviving spouse receives a monthly pension benefit, the health benefit premium will be deducted from the surviving spouse's pension benefit. If the surviving spouse does not receive a monthly pension benefit, then the surviving spouse will have to submit premium payments to the pension fund office. Okay. So this was a fantastic benefit improvement. I can't tell you how excited and happy people were. We've placed a lot of the surviving spouses on coverage. This surviving spouse coverage is also available if you pass away prior to retirement, but there's some conditions on that. If you pass away prior to retirement, you, the carpenter, would have had to have been at least 60 years old, and you have to be covered by the active working carpenter benefits or the active working carpenter COBRA benefits in order for your surviving spouse to come on to the retiree benefits. And in those situations, your surviving spouse would have to be eligible for a joint and survivor monthly pension benefit. So in essence, by saying the spouse also has to be eligible for a joint and survivor benefit if you pass away pre-retirement. Pre-retirement, the spouse has to be eligible for a joint and survivor. In effect, that really means you have to have been married for a full year before your passing, before the carpenter's death. Okay. Post-retirement, if you pass away post-retirement, you do not have to have a surviving spouse eligible for a joint and survivor. Even if you've taken the 60 certain, the surviving spouse can still have health benefits. Okay, I'm almost done. I see we ran an hour late. I'm going to circle back to questions. So if you've typed a question, give me a minute. I'm going to go read the questions in a minute. But for those of you who need to jump off, I would like to please remind you to, when you close your webinar, please stick around for a minute and answer the couple of questions on our survey. I also want to remind you again that the fund office, even though we're closed to outside visitors, we are available to meet your needs over the phone. Okay, you can call with questions. You can schedule a telephone appointment. The pension department team, the retirement benefits department team, they're an awesome group of people, and they can certainly help you with your questions. And I'd like to tell you a great big thank you for attending our first webinar. I got some valuable feedback on how long it takes me to talk about all of this information, and we'll take that back for the next webinar that I'm sure we'll be hosting shortly. I appreciate your attendance and any comments you might want to make on that survey portion. Thank you for your patience also. Now I'm going to jump over to the question screen where you've been typing away some questions, and if you give me a moment, I'll see what kind of questions came through. A surviving spouse is also eligible for vision and dental. Okay, so the surviving spouse can also choose to take the vision and dental. It looks like the questions that have come through that I've answered most of them. Here's a good one, and I do apologize, I forgot to say this. On the vision and the dental, we talked about in order to postpone coverage, you have to have coverage in the middle, creditable coverage from another provider in order to come back to us later. That's different for vision and dental. There is an open enrollment period every year for vision and dental. So starting about January 15th and running until March 15th of every calendar year, we have open enrollment for vision and dental. So even if you didn't have other vision or dental coverage, you can enroll during that open enrollment period from January through March, and your coverage for vision and dental would start for April 1st. Okay. Another question, we talked about COBRA coverage. You can come onto the retiree plan after COBRA coverage. Someone's covered by low cost coverage, which is another option on the active benefits. Yes, if you have low cost coverage, you can run out your low cost coverage before you come on to the retiree plan. But you have to have been enrolled in the low cost coverage before your pension starts. Because once you're a pensioner, you're not allowed to enroll as a new enrollee to the low cost benefit. If you are already enrolled in low cost, you can stay on the low cost and finish out the low cost even though you become a pensioner. But if you're a pensioner before your active benefits end, you will not be able to pick up the low cost. Those are all the questions that I'm seeing. So I appreciate your time and your patience. A couple of questions came through about the supplemental retirement plan while I was already talking about health benefits. Please give the retirement benefits department a call. We're happy to talk with you. You know, this webinar setting, it's kind of difficult to answer everybody's questions. I did the best that I could, and I hope I got to most of your questions. So I appreciate your spending time with me today. I hope you enjoy the rest of the weekend. Please fill out the survey and give the retirement benefits a call. Also, if you need us to mail you out paper copies of the presentation or the handout through the mail, give us a call. We can do that for you next week. Okay? That's all I have for you today, folks. Thank you so much. Enjoy the rest of your weekend. Bye-bye.